I'm Caroline Hyde from London, in for Emily Chang. This is Bloomberg Technology. Coming up, Netflix sets the bar, leading the charge for the next quarter of big tech earnings. We'll break down its record-breaking scorecard. Plus, after Mark Zuckerberg's marathon Q&A session in Washington, he's got another date with a top EU watchdog. What to expect from this week's big meeting in Silicon Valley. And the US Supreme Court prepares to revisit a 1992 decision that could rewrite the rules for the tech industry. Etsy's CEO joins us ahead. First to our lead, and Netflix shares surging in late trading after reporting its strongest start to a year since the company went public 16 years ago. Now, the streaming pioneer added 7.4 million subscribers in the first quarter. It's beating the estimate of 6.4 million. Netflix now has more than 125 million paying customers, the most of any online TV network. The company is the best performing stock on the entire S&P 500 this year, proving one quarter at a time that investors' confidence in its online TV service has been justified. Joining us now to dissect the report, e-marketer analyst Paul Werner, who joins us from Boston. And with me in London, it's our guest host for the hour, Henry Lane Fox. He is the CEO of Founders Factory, a tech-oriented venture capital firm specializing in startups, early-stage companies and pre-seed funding. Gentlemen, I'm going to turn my attention to Paul, you first. And these numbers, I mean, subscribers added, prices going higher. What's the secret sauce?
I think it's content. They're making shows that everybody wants to watch. So as long as that's the case, then people are going to subscribe and stay with Netflix. So it's been an amazing story for them.
An amazing story that they have just continued to be able to show that as they expand their user base, they are indeed also able to up the prices consistently. I mean, are you expecting these sorts of heady heights, the amount of numbers they're seeing, the subscription numbers they're seeing, the revenue they're bringing on, to be able to be repeated quarter after quarter?
I don't know if the kind of growth that they've posted in the last three quarters is sustainable on a percentage basis. I think at some point they reach saturation and they get to a point where they really can't post those kinds of revenue increases every quarter. But I do think that as long as they keep, making these great shows, that people will continue to tune in. They still have a lot of international expansion ahead of them, so they're on a good track. They're not going to sustain these kinds of numbers forever, but they also, I think anyone waiting for the other shoe to drop for Netflix is going to have to keep waiting for a while.
Yeah, Henry, I mean, this is phenomenal user growth that we're seeing. Content is king. Can anyone play catch-up?
Well, that's a great question, Caroline, and I think it is interesting to look at the landscape of people who might yet find a way to compete with Netflix. Amazon is clearly one company who has started to invest very heavily in original content, has a lot of data on users, has a very big distribution channel it could deploy. I think it's an open question whether anybody will catch Netflix. I remain a Netflix bull, but I think that it's interesting to think around how Disney might find a way yet to compete. If you play forwards a couple of years in an imaginary world and believe that Disney does manage to acquire 20th Century Fox and goes live with its planned streaming service, I think bringing its historical archive, bringing the very high quality production focus that it has in the movie sphere, and the ability to weave in merchandise in a way that maybe Netflix has not yet been able to do, to be able to increase its ARPU, could yet become a competitor.
Fascinating points that Henry brings up there, Paul. Where are you seeing the competitive landscape? I mean, do people just have more subscriptions to more different types of products, or is it a winner-takes-all expectation here?
Well, there has been a rising tide with more and more subscription services and more spending on them, and no sign of that slowing down yet. Like everything else, that's not sustainable either. I agree with Henry that competition is coming from all quarters. The companies he mentioned, certainly Fox and Disney, big competitors, and especially if they tie up. And then you do have Amazon, you have Hulu, and you have potential competitors like Apple and Facebook that really haven't tipped their hands fully in this game yet. But once they start, they have the kinds of budgets that Netflix has been throwing around, and they have the expertise, the relationships, so they could also give Netflix some serious competition going forward.
I mean, talking of perhaps how the share price has performed and whether there's competition there, I'm diving into my Bloomberg GTV if you want to look yourself, and you can just see how Netflix has left the rest for dust when it comes to share performance. We're up 60% so far year to date. They're in the yellow. We are seeing a vast outperformance versus the likes of Amazon in the blue, versus the likes of Alphabet in the purple, Apple in the pink. So clearly they're streets ahead in that respect. Henry, what about the world you're looking at, the startup world? Are there people trying to emulate what Netflix does, build on what Netflix does, or the subscription model in any way?
Absolutely. So I think we look at Founders Factory, we look at the industry at large, the whole of media. That's a very broad remit for us. We do see increasing numbers of subscription models across all different media formats, actually, from traditional press publishing and twists on those models through to reinventing audio and podcasts, right through to film and TV subscriptions as well. I think there's a huge allure in subscription models from an investor perspective. They tend to be very sticky revenue patterns. They're very predictable revenue sources. And at the same time, there is a very large barrier to entry as it becomes clearer that extremely high quality production content is required to lure people onto these subscription packages. But it's an area we see an enormous amount of activity, littered gravestones all over the place over the last 5 years of people who've tried to play in paid content and failed. But I think the tide is beginning to change, and consumers begin to understand now that there is a proper value exchange in being a customer and not being a product of these services. I often cite the Guardian Media Group, our investor in Founders Factory, who are actually having a very strong subscription increase now in their revenue streams. So I think there are opportunities not just for new companies, but for traditional media businesses to reinvent themselves along the Netflix model.
That's interesting. I mean, Paul, I'm also looking at, you said really anyone who's been betting against Netflix is probably going to continue to fail in this respect. I'm looking at short interest in Netflix at the moment, and that's just continued to tail off. If you go into Bloomberg and go into GTV once again, you can see in the white line how we've just seen a continued upward trend in the Netflix share price, but in the blue line a continued downward trend in terms of short interest, where it, only just 4% of all equity that is floating is currently shorted. Do you remain, out the game if you're going to be a bear on Netflix? Do you think that this is really a bull's view of the world?
I think Netflix always has and is still playing the long game. And one thing that's interesting about content libraries is that they're cumulative. They build up. You invest in content, and it's always there for you to return to. A show that's popular today may go through some ups and downs, but eventually people come back to it. They want to tune in to the next season of a show. So I think Netflix has been doing that very, very well, building interest and retaining their customer base. And as long as they keep doing that, they may have some ups and downs in future quarters, but I don't see the story changing for the worse unless really the market underneath them tanks or something drastic happens to their business or the content. But it's really, as long as they keep doing what they're doing, they're going to keep succeeding, and they're also going to have that back library to fall back on.
Biggest first quarter as a public company, revenue up 43%. They're able to up prices and subscribers. It's a heady mix, and even Standard & Poor's giving them an upgrade on their debt rating. Fascinating conversation. Paul Werner, analyst at eMarketer. Great to have you joining us from Boston. Thank you very much indeed. Founders Factory CEO and guest host for the hour, Henry Lane Fox, is going to be sticking with me. Now, the Federal Communications Commission has announced a $40 million settlement with T-Mobile US. The settlement is over accusations that the carrier made it seem that outgoing calls were ringing at their destination when they weren't. T-Mobile US admitted that it violated a provision against inserting false ringing sounds and that it didn't correct problems. Now, according to the FCC, T-Mobile US reported that it had injected the false ringing sounds on hundreds of millions of calls. Now, why on earth do this? Well, with the false ringing sounds, the calling party believes that the phone is actually ringing at the called party's premises, obviously, when actually it's not. As a result, the caller may hang up, thinking nobody is available to receive the call, thus saving T-Mobile fees it would have had to pay the local carrier. Now, coming up, the US Congress called and Mark Zuckerberg answered. Now he's getting ready to meet with a top European regulator. That's next. And if you like Bloomberg News, check us out on the radio. You can listen on the Bloomberg Radio app, Bloomberg.com, and in the US on Sirius XM. This is Bloomberg. Now, Facebook is providing more information on what data it collects from users when they're logged out of the social media site. Websites and apps that use Facebook services to make their content and ads more relevant may receive information even if you're logged out or don't even have a Facebook account. Now, in an online statement, the social media giant said this happens because other apps and sites don't know who is using Facebook. Facebook added that users can opt out of these types of ads entirely. Meanwhile, Mark Zuckerberg withstood over 10 hours of questioning by US lawmakers, and now he's getting ready to meet the European Union's top regulators as well. The Facebook CEO is set to meet with the European Commission Vice President Andrus Ansip during a two-day trip to San Francisco starting Tuesday. This comes as the EU is planning to unveil new legislation next week aimed at shedding more light on how tech giants are dealing with customer complaints. For more, let's go to New York, where Bloomberg Technology's Sarah Fryer is standing by. I mean, your amazing reporting continues and your focus on the company. And Sarah, I mean, he's not coming to Europe, but Europe's flying out to him, it would seem. What are we expecting in the meetings with the chief digital regulator?
Well, as we saw last week in testimony, there were a lot of questions about whether Facebook likes the GDPR rules and going to roll them out. Of course, they have to now in Europe. He's also going to be meeting with Sundar Pichai of Google, so it'll be a very educational trip, I'm sure. He's met Zuckerberg in the past, has said it was a very, very cordial meeting. They shared some information. He's met with Sheryl Sandberg in the past. Now I think things are getting a little bit more serious as the EU wants Zuckerberg to come testify, just like everyone else wants Zuckerberg to come testify. He's quite in demand these days.
Isn't he just indeed? And of course, they met a couple of years ago in Barcelona for Mobile World Congress. I want to get an opposing views here because I've got a European sat next to me. I'm going to be asking you first, Sarah, how do the big US giants that you report on, including that of Facebook, really view EU regulation? It is tougher. It is more, perhaps at times, ahead of the curve, as Sheryl Sandberg herself has admitted. But do they feel targeted in any way?
Well, I think that Zuckerberg has made the point that they will try to give the same protections to users around the world. I think he'd rather be in control of it himself than have it be regulated onto him. Facebook, their best chance right now is some sort of self-regulation that gets the government to decide, oh, yeah, OK, you're doing well. And then if they get it into law, that will potentially help Facebook by preventing younger companies from being able to get to Facebook's side. Of course, regulation is something that a company with a lot of resources has an easier time putting into effect. So it'll be really interesting to see how this unrolls around the world, not just in the US.
Fascinating. Let's bring in our guest host for the hour, Henry Lane Fox, of course, of Founders Factory. It's interesting that we've got about to unveil here, May the 25th, GDPR, the General Data Protection Rule, which would be able to ensure the data debacle that occurred to Facebook would have penalties if it occurred today. How are you seeing the reaction to Facebook, the fact that it was a UK company that was involved in the heart of this with Cambridge Analytica?
Well, that's a great point, and I think there is a slight difficulty sitting here in the UK and being too complacent about how great we are. I think one of the things that's very encouraging, though, is to see Europe leading the way when it comes to a regulatory approach, and that is being taken seriously by the tech giants in the Valley. I think it's also at the same time important to remember that Europe has a wonderful ability to suggest what regulation might be best to come into effect, but fundamentally these data monopolies are growing up in two markets, first in America, but also in China. And Europe is in many ways a slight backwater compared to the size of those consumer populations. So I think it's great that we're providing our influence. I think there is a very open question as to whether we're really going to reach a global coalition of regulators to prevent these data monopolies. And in the end, I believe that that is required.
Sarah, take us back to some of the news that we've seen breaking today with Facebook as well, because we are hearing them outline how they won't be tracking perhaps, or try to explain the tracking of when you aren't a user of Facebook, when you aren't logged on to Facebook.
It's very confusing, Caroline. Basically, Facebook is saying that last week, and I should say in testimony, Zuckerberg said that the reason that Facebook needs to track non-users was for security purposes, but that they would be getting back to Congress with more reasons. Today they published a blog post saying that it's not just security purposes. In fact, it's mostly for business reasons, because the various apps and websites that use Facebook login or use Facebook's advertising services or use any number of Facebook analytics products, those sites and apps send information back to Facebook, and then Facebook, it doesn't discriminate whether or not that information comes from users. Facebook just gets all of it. And then with the information on non-users, Facebook can do whatever it wants, including targeting those non-users with ads, it said, to join Facebook. So certainly not just for security purposes. So very interesting to see them admit that today.
Facebook do whatever it wants. Perhaps that will be no more, certainly when it comes to European regulation. Bloomberg's Sarah Fryer, fantastic to have you joining us as ever. And of course, Henry Lane Fox, CEO of Founders Factory, is my guest host for the hour and he's sticking with us. Now, coming up, WeWork is doubling down in London. We have the details on its latest multi-million-dollar office complex. That's next. This is Bloomberg. Now, yet another Chinese technology company is headed for an initial public offering. This time, Tencent-backed Meili Shaw is said to be seeking an IPO of at least $4 billion valuation. The online fashion retailer is said to be in talks with several investment banks for the US deal. As of 2016, Meili Shaw had about 15,000 merchants on its site and 100 million downloads for its mobile app. Now, a bit closer to home where we sit now, WeWork continuing to double down in Britain. The startup that specialises in shared workspaces is teaming up with two other firms to pay $826 million for an office complex in the heart of London. Bloomberg News reported last October that WeWork, which is backed by SoftBank, entered negotiations to buy the complex. US-based WeWork announced today that the deal was closed without disclosing the purchase price. Still with us, guest host of the hour, Henry Lane Fox, Founders Factory CEO, and someone who helps in the birth of new startups, new companies, and therefore this sort of flexible working space, is that a benefit for them?
Unquestionably. I'm a huge fan of WeWork. An enormous amount of our portfolio businesses have availed themselves of their services. I think it's a really fantastic thing for London, and I think this deal really says London's here to stay. Yeah. It has a thriving ecosystem of startups. We're very lucky to participate in it, and there's no sign of any of the growth trajectory abating around our startups launching. And given Brexit and lots of other conundrums in the UK at the moment, I think it's really reassuring to see that people are still prepared to make very sizable investments here, betting on the fact that London is a wonderful heartland for European ecosystem of technology.
You say given Brexit, why isn't that putting off startup founders coming to bear their companies here?
Well, that's a great question, and I think there's, in simple terms, three things that we have that lots of other cities in Europe don't have. So we're very fortunate to have a wonderful creative industries network here, outside of broader than just technology. I think we have incredible university talent coming out of all of the universities across the UK. And on top of that, we have access to very smart money, not just capital, but people who really understand how best to help your businesses grow. And I think those three things are very hard to replicate.
It is, of course, of a bigger scale in Silicon Valley. When you are talking to the startups that you're helping found, when you're looking at companies that you're investing in via the fund that you've raised as well, do many of them still hope to go over to Silicon Valley, or do they think that they will take their company to full fruition here in Europe?
Well, the best entrepreneurs for me still pose the question, how do I scale in Europe and then go to the US and buy a tech giant? And those are the entrepreneurs I personally want to back. I want to see that happen in the next 10 years. I think we will. I think what's interesting to me as well, though, is the number of companies from far afield as Uruguay, Japan, Korea, Canada and America who are actually coming here to base themselves and think around Europe properly as a market. And we see a huge influx of applications to Founders Factory from startups from across the globe, and that's enormously reassuring for us.
Any particular areas in particular that you think the hustle is coming in particular? You talk about how we have creative skills, advertising comes to mind. Are there particular areas within tech that London is the beacon?
I think so. So, I mean, a lot is said as to whether our AI research here is as good as it is anywhere else in the globe. I argue it is. I think that we've got enough proof points to say that now. So there's a very strong heartland for machine learning talent here in the UK. Obviously, financial services, we've been the heart of financial services for a very, very long period of time. And there's, again, an enormous amount of very intelligent capital put to work in the city. So I think growth of fintech has been astronomical over the last few years. I'm personally also interested in cyber. There's a big mission now by the government to try and develop a more encompassing cybersecurity framework to help startups grow here in the UK, using the government as a buyer of their services. They're going to be making some big announcements on that in the future. I think that's another great sector for us. Robotics as well as another one where we're making a lot of investments, seeing some wonderful entrepreneurs coming out of universities. So, to be honest, it's an enormously broad landscape, but I think those are some areas where we have a real competitive advantage.
Optimism in your voice, Henry.
Absolutely.
Great. Thank you very much indeed. Henry Lane, Fox CEO of Founders Factory, guest host for the hour, is going to be sticking with us. And coming up, we were just talking about it, artificial intelligence in the UK. What British lawmakers are doing to make sure that they're ready for the coming AI wave. That's next. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology. Weekdays 5 p.m. New York, 2 p.m. San Francisco, 10 p.m. in London. This is Bloomberg. This is Bloomberg Technology. I'm Caroline Hyde in London. And back to our top story of the day, it's got to be Netflix, posting its strongest start to a year since the company went public 16 years ago. Netflix sales growing at the fastest pace in history thanks to the combination of subscriber growth and higher prices. Check out that share bounce in after-hours trade. The subscriber growth, in fact, grew 25%. Meanwhile, the ASP, or the average subscriber price, that grew 14%. Joining us for more details from Los Angeles, it's Bloomberg's Lucas Shaw, who covers the company, and it seems to be the perfect mix. They're able to push up their prices and they're able to increase their subscribers, and it doesn't seem to be in any way shaken.
Yeah, it's getting a little ho-hum right now, actually, with the Netflix earnings. You know, I remember there were years where each quarter you wouldn't know going into it, is it going to be way up, way down, because the stock would just seesaw so much if they missed even by a couple subscribers. The past few quarters, they have just blown through their estimates, despite raising prices over the past year for about 80% of their customers, which suggests that that's really having no effect on the business, and they'll probably roll out another price increase sometime in the next couple of years. You know, what I'd love to find out is if they would break out some of their subscriber growth in individual territories instead of us having to rely on analyst reports to know that they're doing really well in the UK or Brazil.
What about, interestingly, many have focused on the debt load, have focused on the cash burn. I'm looking at GTV on my Bloomberg. You dig in and you can see how much cash they've really been managing to burn through, more than, what is it, $500 million at times per quarter. What, therefore, this doesn't seem to be an issue at all, Lucas, given that we've just seen Moody's actually upgrade their debt rating. So people seem to like the way they're spending because it's on content.
Yeah, it's this cycle that they have managed to work out, where they are allowed to spend and borrow as long as the subscriber growth keeps going, because they have convinced people that the spending is what's fueling that subscriber growth, that all the new content, all the deals with Ryan Murphy and Shonda Rhimes, stand-up specials every week, a new movie every week, that's justified because of the long-term effect. And the real question, I think, for bondholders, for investors, for everybody will be how long can the numbers keep going up at this rate? At the moment, it's continued for a couple of years. If it keeps going for the next 3 or 4, then it doesn't really matter, because at some point they will pay it off.
How big can this company get? Lucas Shaw, fantastic reporting on T-Live as well. If you go to the Bloomberg, some great blogging there throughout the earnings. Thank you very much indeed. Now, artificial intelligence. It's already here and becoming a greater part of lives every day, but that hasn't stopped people from worrying about it. In fact, in a recent report by McKinsey, it estimates that up to 800 million jobs could be lost worldwide by 2030. Additionally, up to 375 million people may need to switch jobs and learn new skills. And now, an influential group of British lawmakers has authored a new report with an additional warning for regulators. don't let major tech companies dominate the growing AI industry. Here with me to discuss, my guest host for the hour, Henry Lane Fox, CEO of Founders Factory, a tech-oriented venture capital firm specialising in startups, early-stage companies and pre-seed funding, and AI. I mean, this is how you find entrepreneurs for the companies that you're building. It's one of the methods. When you look at MPs getting involved, having a look and saying, hey, we're worried about a monopoly of data by the likes of Google and Facebook and behemoths, is it something that you worry about too?
I think it is a legitimate worry. I think that obviously largely the House of Lords and the regulators we have here in the UK are reflecting a public sentiment that I think you're right to say is increasingly nervous in technologies that they don't understand. I think, having said that, there's a lot of hype within AI. It's very rare to find an AI system that is truly autonomous right now. There is almost always a human in the loop for almost all the AI companies we see at this stage. I think, though, the question of whether we are building and allowing companies to build big data monopolies is a valid question. I think really the question is, how do you combat that? I think if you think around how we had traditionally regulated in the world of utilities, it tends to be you're only allowed so much of the market access, we'll restrict your pricing to a certain degree. What does that look like when you're combating a data monopoly is an interesting question. Lots of people have put forward different theses. But from a personal perspective, I've always been rather sympathetic to the idea that we should perhaps look to enforce upon these tech giants some way to share their aggregate or parts of their aggregate data sets to allow younger companies to innovate on the back of it. Yes, they could receive some form of license fee for opening up their data sets, but maybe there does need to be some form of regulation that encourages them, or some change to the incentive structure perhaps, that encourages them to be more open with their data. Having said all of this, obviously, data is not the pure lifeblood of AI systems, and that may sound like a strange comment, but historically we needed a lot more data to train the AI models that existed. And actually what's going on at the moment is we've now built AI models that can self-train on very low levels of data. So there is an argument that actually the data monopoly per se may not be where the magic now occurs. And I think you can see that partly in the number of small-scale acquisitions that the tech giants have made, not just here in Europe, but in the US, often acquiring very, very small specialist teams who've had a breakthrough at the algorithmic level that actually is enormously valuable even to those tech giants.
Are you looking for companies that are going to be valuable to these tech giants?
Well, yeah, that would be perhaps a mug's game to try to do that, but we do try to invest where we can in industry-defining propositions. We're very fortunate at Founders Factory to have an investment thesis that covers 6 different industries, and we actually treat AI and deep tech as one of those industries. But it applies for us in financial services, where we're working very heavily with an insurer, Aviva, who have an enormous presence in here in Asia, enormous amount of work in developing new risk models around insurance that has actually been very statistical for a long period of time. What is AI other than very large data sets and some quite complex maths? People would argue that many components of it have existed for a long period of time anyway. But we get to see it from the insurance and fintech perspective. We get to see the applications of it in media. We get to see the applications of it in spotting beauty trends for new products that one of our investors, L'Oreal, might like to build. We're invested in a startup called Lumo that has a very groundbreaking technology in accurately predicting flight delays. Now, these are things that make consumers' lives far better. Who would want to go to an airport and sit in a dreadful queue finding out that your flight has been delayed for 24 hours? Far better to get a notification on your phone a day in advance saying, look, there's an 80% chance that your flight's going to be delayed. Do you want to rebook now? So I think many of the applications we look at are actually very positive, both positive for the consumer and indeed positive for society at large. You know, we have a treasure trove of data existing within the NHS, and yet we have a very stretched health service. We're excited by a startup we've invested in, a very, very early stage startup called Peptone, that's using a new form of AI to generate alternative proteins that could be used for different types of drug discovery. And I think there's an enormous benefit in opening up the right data sets to people who are going to behave ethically with those data sets and generate enormous economic and social value for many, many different territories in one go.
And there it is, it's the ethics.
But the machine ethics question won't go away, and we've spoken about it for a long period of time. I welcome what the government has put out today as at least a set of principles on which we could organise ourselves, but I think I'd challenge them. There's only some skill in saying what or why. The real underlying question is how, and they have no answers for that right now.
Henry, you've had plenty of answers for us today, though. Thank you very much indeed. Of course, that was Henry Lane Fox, CEO of Founders Factory. He's our guest host for the hour, and it's been a great joy to have you joining us. Now, coming up, They were the Facebook ads meant to sow discord and division. Now there's new light being shone on their shadowy buyers. That's next. This is Bloomberg. New intrigue into divisive political ads that were bought on Facebook ahead of the 2016 US presidential election. More than half of the sponsors of those infamous ads have little or no public paper trails, and 1/6 of those ad buyers were linked to Russia. Now, this is according to a new study from the University of Wisconsin-Madison, where researchers examined 5 million ads that ran from September to November of 2016. Joining me now from DC, the study's lead author, Professor Youngmi Kim of University of Wisconsin-Madison. Wonderful to have you with us. Fascinating, the research that you have done. And talk to us about who actually was running these sorts of ads. What actually made you realize that they were in some way suspicious?
Good question. So we examined 5 million paid ads on Facebook. They're exposed to nearly 10,000 volunteered users who represent the voting age population in the United States. We tracked the sources and the sponsors behind these political ads. We realized that most of the groups who ran these divisive issue campaigns are anonymous, meaning that unidentifiable, untrackable suspicious groups that have no public footprint, or unregistered ASTRF groups, or nonprofits who did not file a report to the FEC, Federal Election Commissions.
What sort of ads were they running?
We focused on divisive issue campaigns, such as the issues like abortion, gun, LGBT, racial conflict, nationalism, and then terrorism, and some candidate scandals. So it included various issues. For example, veterans before illegals that emphasize the division within the public, or the Syrian refugees are attacking us, that emphasize, that raise the fear and the threat, things like that. Some of the ads contain a candidate attack, like arrest Hillary, things like that.
And why don't you think Facebook really was able to find or flag these ads at the time, flag them as suspicious, and knowing what we do now, do you think that the activity would be more easily able to be tracked and shut down in the future?
That's a good question. I think there are two issues we have to highlight here. So one is that it's just that the way digital political campaigns work on social media, so-called dark posts, meaning that ads are seen to only a small segment of the population. So the ad content are not not necessarily publicly accessible. That's the way it works, and that's the big difference between the broadcast advertising. So it's not just a Facebook's fault. That's the way it works. But another thing I really want to emphasize is that the regulatory loopholes. Currently, there is no law adequately addresses digital political campaigns in the United States. A lot of researchers offered some explanations for why we found these anonymous groups rampant, or fake news organizations are rampant on the social media. But the issue is that it is not about not so much about affordance, not so much about people's psychology of being selectively exposed to certain media content. It is because there are loopholes where unknown actors could take advantage of these loopholes. So in the future, if we have adequate regulatory policies or guidelines, this gap might be tightened.
Well, when you sit from DC, more regulation to come. It might be what you're calling for. Professor Youngmi Kim of University of Wisconsin, wonderful to have you joining us on this piece of research. Thank you.
Thank you for having me.
Now, up next, we're going to be speaking to the Etsy CEO, John Silverman, joining us ahead of Tuesday's multi-billion-dollar US Supreme Court hearing. That's online sales tax. And a quick programming note, if you are watching us in San Francisco, you can also hear us on Bloomberg Radio. Bloomberg Technology, the only daily news program focused exclusively on technology, innovation and the future of business, can now be heard every night, 7 p.m. Pacific on Bloomberg 960. This is Bloomberg. Reports out that Amazon has shelved its plan to sell and distribute pharmaceutical products after considering it last year. Now, shares of drug companies and providers jumped in Monday trading off the CNBC report. Meanwhile, Oracle's co-CEO Safra Catz says the Pentagon's plan to award a single contract for multi-year cloud services makes, quote, no sense. Bloomberg reported earlier that she had criticised the bidding process at a private dinner with President Trump this month. Catz says the procurement process seemed designed to benefit Amazon. A final request for proposals, which outlines a 10-year contract, is scheduled to be released in May and awarded by the end of September. And speaking of Amazon, well, a debate over online sales tax is at the centre of a multi-billion-dollar US Supreme Court case set for argument on Tuesday. States and traditional retailers are asking the court to overturn a 26-year-old ruling that exempts many internet merchants from collecting sales taxes. The 1992 decision says retailers can be forced to collect the tax only if they have a physical presence in the state, such as a store or warehouse. If overturned, well, this would put new pressure on online retailers that don't always collect taxes, including Amazon, eBay, Etsy, and thousands of small merchants. Joining us now from New York is Etsy CEO Josh Silverman. Josh, thank you very much indeed for joining us. And just how big a difference would this make to your business if we did indeed see an overturning in this rule?
What we're talking about here is the new Main Street, the digital Main Street, being subject to a patchwork of 10,000 different tax jurisdictions, where our sellers, micro businesses really, are asked to comply with an unmanageable number of tax laws.
So complexity abound. What about whether or not there's a risk that you could see back taxes as well being collected? Is that a risk of yours, or do you think that's not on the agenda?
Most important thing is, let's take an example. One of our sellers selling in the state of Washington, she sells marshmallow pops and she sells pecan bars. It turns out that marshmallow pops are qualified as a candy, which has no tax because it doesn't include flour and doesn't need to be refrigerated, where pecan bars are classified as baked goods. And so she needs to know that in order to be complying with the tax jurisdiction of one jurisdiction within the state of Washington, unless perhaps it's back to school, in which case there might be a tax holiday. In the state of Connecticut, she needs to know whether the sandals she sells are for athletic purposes or not, unless they're being bought by, for example, someone from the PTA, in which case they might have a tax holiday. So the challenge here is that there is a really unmanageable number of jurisdictions for which no small seller could truly comply.
So back tax is perhaps not on the agenda, but the complexity is front and foremost. If the Supreme Court doesn't overturn this rule, for example, Josh, what do you think we might see state by state start to crack down on this in some way? And how do you manage your business for that future?
Right. So it's not about back taxes. It is about forward looking, and it is exactly about state by state. So about 25 years ago, the Supreme Court ruled that individual states cannot force people that do not have presence in their state, do not have physical jurisdiction in their state, to comply with each and every tax jurisdiction. That's what's at risk right now. So if that ruling gets overturned, then a micro seller who sells, let's say, on Etsy from her living room will suddenly need to comply with over 10,000 different tax jurisdictions. The way it works right now, if she doesn't have physical presence in a particular state, then she's not subject to the tax jurisdictions within that state.
Have you put in place provisions for if it indeed is overturned? I mean, have you factored in extra costs to your business in this respect of having to comply?
It's more than cost, really. It's about how much time is she going to have to spend trying to comply. So, of course, we're going to have the backs of our sellers. But should the Supreme Court overturn the Quill ruling, which is what's being discussed today, it would likely go to Congress. And then Congress would need to decide how to make this manageable for sellers. The worst case scenario, we think, is that every state gets to impose its own tax rules on every single person who sells into that state. That's really going to create terrible friction for sellers, and it's going to really hold back jobs, and it's going to hold back the success of micro entrepreneurs, so much of the economic engine of our current economy.
Talk to us about having the back of your sellers, because notably KeyBank have been saying that you're improving your service for your sellers at the moment, going to be helping them target potential shoppers that much more. But many feel that perhaps you've abandoned them when going into bricks and mortar, actually within state by state. Well, what are you doing for your own sellers, your own customers?
We've been working very hard to make the Etsy platform an even better platform for buyers, which will make it work even harder for sellers. And we've been seeing terrific progress. So sales have been accelerating quarter over quarter. In fact, in the fourth quarter, we did over $1 billion of sales. So the work that we've been doing has really paid off, and our sellers are being more successful selling more product as a result.
Josh Silverman, it's been great having your take. We'll hopefully keep in touch as this does indeed move through the Supreme Court. CEO of Etsy, wonderful to have your time today. Thank you. Now, a reminder that we are live streaming on Twitter. You've got to check us out. It's at Technology weekdays at 5 p.m. in New York, 2 p.m. in San Francisco, 10 p.m. right here in London. That's all for now. This is Bloomberg.